and welcome to this live webinar where we'll be discussing why access to visionary founders and academics really matters when investing. This is a 50-minute programme brought to you by Citywire and the team behind the Baillie Gifford Scottish Mortgage Investment Trust, or SMT as many of you know it. My name is Amy Maxwell, I'm from Citywire and I'll be presenting today's broadcast. Today we'll be joined by our guest, Lawrence Burns, who is a partner at Baillie Gifford and Deputy Manager on the Trust. This is the first webinar Lawrence has done in this role as Deputy Manager, so I'm sure viewers, you're as excited as I am to hear what he has to say about uncovering the extraordinary companies of the future. Now, a little bit about how we're going to run today's session. In the first 25 minutes, I'm going to interview Lawrence, and then we'll be putting your questions to him in the Q&A session in the closing 20 minutes. So if you do have a question for Lawrence, you could submit it at any time via the Q&A box in Zoom. Now let's begin. Welcome, Lawrence. Thanks for joining me today.
Great. Thank you for having me.
So Scottish Mortgage Investment Trust, or SMT, is a portfolio of some of the greatest growth companies in the world. The exclusivity the team has in terms of access to top management is pretty anomalous. So how has this been achieved? How did you get there? And how do you think it can be sustained to find more extraordinary companies in the future?
Yeah, thank you. I think the word anomalous is right. We're in a really privileged position in terms of the access that we get, and I think it's a real advantage for us as investment managers and therefore hopefully for shareholders of Scottish Mortgage. It's probably just worth sort of highlighting the nature of that access and then going on to talking about how it can sort of be sustained. Yeah, it won't surprise the people listening that I didn't do as many overseas investment trips as I would have liked to in the last year. But the most recent one I did was to Berlin in October. And we were able to meet the founders of all of our Berlin-based companies, as you might expect. But to give a specific example, I reached out not long before going to the founder of Zalando and sort of said, "Oh, would you be kind enough to meet with us? We'll be available at 11 or at 12." And he replied back sort of instantly saying, "Well, we can do both those times. We'll spend 2 hours with you." And then he said, "Are you coming in for the night before? And if so, would you like to go to dinner with me and my co-founder?" And so because of that generosity, we were able to spend in a day and a bit in Berlin about 5 hours with the founders of Zalando and their senior management team. And I think that is quite anomalous in terms of the level of access. And it's not just the quantity of time, but also the nature of that time, that when you build relationships with people that are more like partnerships, you get conversations that are more open. They're more willing to talk about ideas, ambitions, aspirations earlier. And I think also to talk about the inevitable challenges that exist within any great company in a more open way, because there's that element of trust that you are long-term supportive holders. You could stretch that as well, going to, when we first met with Elon Musk, the SM managers back in 2013, getting to hear directly from him his vision of what Tesla could become, and hearing his ambition that he thought there was a small but growing chance it could become $1 trillion company in the world's largest, sort of 9 odd years ago. That was really helpful, I think, in us understanding the possibilities that Tesla had. So that access is really helpful. In terms of where it's come from, originally it just comes from many, many years of doing what we say. People should rightly be suspicious of people that come onto their shareholder register and say that they're long-term, because very few people, I think, frankly, are. And so for a number of companies, it was acting that way in the good times and in the bad times. And it's where share prices tumble and you can remain a steadfast partner and continue to be focused on the long term, that people, I think, really value what you bring. And I think as we move forward now, what is helpful is 10 years ago, we might have had to spend several years trying to prove ourselves to companies, but founders talk to each other. And so we have founders that we've invested in that vouch for us to other founders. And so to get that level of access and that exclusivity that you were talking about, we don't need to spend years anymore. It's something we can get from day one. And again, I think that puts us in a very good position for insight. And the final one would just be, we're talking here about public companies. All of this starts to matter a lot more for private companies. Public companies, they can choose who they want to spend their time with and who they want to talk to. But private companies can also choose who they let invest. So we could all invest in public companies and Tesla and so on, But a SpaceX, a ByteDance, which is the owner and creator of TikTok, they can be very selective about who they let invest. So there, the access and the advantage we have is not just about access of talking and understanding, but it's also access to the opportunity in the first place.
And you spoke there about sticking with the companies during difficult periods as well. We've had a fantastic run recently, but now we are getting kind of a macro headwind in the form of inflation. So do you want to pick up? Let's address this point head on up front. It's certainly creeping up, and the potential for tighter monetary policy is leading to quite a lot of uncertainty over whether growth stocks can continue that fantastic run that they've had. Do you have a few words for our viewers who have been in touch in advance to ask, can you allay any of their fears here?
Yeah. So I think the first thing to say is that, periods of stress, periods of difficulty are sort of par for the course. I mentioned Tesla earlier there. I think we first invested in 2013. There's been over 10 instances since then of sort of 30% drawdowns. Even for very great companies, the path isn't a straight line. Volatility is something that if you want good long-term returns, you have to accept that the road's going to be bumpy there. And I think for us, it's about continuing to focus on what are the outcomes for these companies in 5 to 10 years' time, not what are the outcomes of the gyrations of share prices over 6 months. So if you look at the interest rates, rising rates do sort of reduce the present value of earnings far out into the future, and this disproportionately impacts growth companies. And I think if you're having an investment on a short-term period, this starts to matter a lot more. And it starts to matter a lot more in part because people are really buying into the market narrative around this. So they're going to buy and sell based on those expectations around it. But I think if you're able to invest on a 5 to 10 year time horizon, I think your perspective becomes quite different. What we're trying to do for shareholders is identify and own the next big growth companies of tomorrow, companies that might be able to deliver 5, 10, 15, 20 times return. In the past, that's been companies like Amazon, companies like Tesla. I don't think their success has ever really been predicated on any of the macroeconomic features that you were talking about there. I think it's far more structural, far more secular, far more specific. I don't think the success of e-commerce or the inflection points in electric vehicles are dependent on interest rates. And so as we look to the future as well, does the success of Moderna depend on these things? I think success is never certain, but it doesn't depend on a lot of the factors that I think are currently sort of dominating the market narrative of whether Moderna can successfully continue to sort of go out from a COVID vaccine to a much broader range of healthcare options and products. And so I think that's the key. And I think from our perspective, we always need to be humble that the ride is going to be bumpy. There may be difficult times. We'll get the occasional odd thing wrong as well, obviously. But as we sort of look at the current environment, our ability to sort of identify and own those next big winners hasn't sort of materially changed from 3 months ago. We're still sort of very optimistic about the scale and diversity of our opportunity set on behalf of Scottish Mortgage shareholders.
Okay, so volatility is very much part of the ride. Let's now focus in on the opportunity set then, as you see it. From our discussions previously, there are 3 broad areas, I understand, where you see massive potential for what you define as transformative change in the coming age. So we've got the continuing transformation, a digital transformation of our world, what's happening in biology and life sciences due to the application of data and computing power, and thirdly, the move towards clean and abundant energy, combined with the electrification of the transport sector. So of those 3 areas, so digitalization, the intersection between biology and data and computing power, and then clean energy, how would you rate your excitement across those 3 areas?
Yeah. And I think those are the right 3 areas. I think the first thing to just say is I find it quite amazing that there are 3 areas. So a lot of people would say the last 10, 15, 20 years has been great for growth investors. And again, I don't think that's down to the inflationary environment or the interest rate environment. I think it's primarily been down to the progress of Moore's Law. That doubling of computing power every 18 to 24 months has meant huge amounts of change and disruption. It's what's powered the opportunity for Amazon and e-commerce, for Netflix, for Facebook, for Google. But what I think is interesting is that that's been so powerful for the opportunity set of the last 10 to 15 years. But what we're seeing is that's broadening. So even within that first one, that continuing digital transformation, we're seeing it broaden well away from the narrow areas or relatively narrow areas of, say, retail advertising and media, going into sort of changing how we consume food, finance, transport. And then on top of that, as you say, we've got the sort of revolution we're seeing in biology. We've got the energy transition, which is very distinct. And so to have not one but three of those sort of fundamental drivers for change, I think is one reason on a very long-term timescale of why we're quite optimistic in terms of the opportunity for growth, that actually it feels more profound and more diverse than it was 10 years ago when we were looking out. But to answer your question properly in terms of which one is perhaps the most exciting, I think that's always difficult to say. I think if I had to choose, I'd probably go for the intersection of biology and information technology. Firstly, because the canvas there is simply very large. At a high level, it's about, we're used to software, we're used to coding information in ones and zeros. That's been incredibly powerful. But this is about moving towards coding in the building blocks of life, of biology, in the four chemical letters of our DNA. And the opportunity set there is hugely varied. It's Moderna's ability to address HIV, Zika, even cancer. It's Ginkgo Bioworks' ability to potentially give us biodegradable plastic. I think the second reason I'd look towards the biology one is I think the impact on people is hugely profound. I'm a big user of Amazon. I love the fact that it's sort of the lowest possible price. I love the fact there's a huge amount of selection. I love the fact I can get it same or next day delivery. That's an impact on society that or at least on individuals' lives, that I think is helpful. But as we move into biology, I think it's much more meaningful that Illumina and Grail have a cancer test that can, through a blood test, detect about 45, 50 types of cancer very early on. That's, I think, a far more profound impact on our society because, again, it's great getting goods delivered in a timely fashion, but that cancer test could save my life or someone close to me life in the future. And I think that to me makes it, really very meaningful. And I think the third reason for choosing biology is because a lot of the change we're seeing is powered by underlying computing power getting cheaper and more ubiquitous, the processing of genomic sequencing, for example, but also the use of data to help guide healthcare decisions, that we are seeing some sort of crude similarity in terms of the competitive advantages and the underlying economics that actually have a bit in common with what we've seen in the digital space. It's been so fantastic because a lot of the underlying tool sets and approaches are sort of leveraging off one another. So the economics of investing in, say, healthcare might be materially better in the future than what we've been used to in terms of the return profile. So, you could really pick any of the three as being fantastic, but I think if everyone was forced to, it would be the biology one. And, Steve Jobs, one of his last predictions before he sadly died was, he said he thought the biggest innovations in the 21st century would come from this intersection of biology and information technology. And I think what's really encouraging us is that we're starting to see companies, business models, and talk to founders that are starting to provide evidence that may very well come to pass.
And let's I mean, this is borne out in the portfolio. The top holding is Moderna. The rationale goes way beyond COVID, which let's just delve into that a little bit more for our viewers so they can understand the true potential here.
Yeah. I talked at an event after Stefan, CEO of Moderna, in a small side event, and I had to follow him. And I said, I had to start with, it's really hard following that because what Moderna have done, firstly, just in COVID is fantastic. They've produced a vaccine in sort of record time that's allowed a lot of us to get far closer back to normality in our lives and saved countless lives. And that in itself is incredibly impressive. But what it's also done is it's accelerated the journey of developing the mRNA platform. And the mRNA platform is basically the ability to get one's own body to almost program it like software to produce certain proteins that might be helpful. So a protein that mimics the shape or structure in some way of the virus to train our immune system, as is in the case with COVID. But that's one application. It's one application of many potential ways that you could use it. It wasn't even the application, obviously, that they thought of initially. It wasn't designed mRNA platform to be a COVID vaccine. It was just utilized because it was the best way to get a vaccine quickly. And so what I think becomes interesting is They've proven that mRNA technology platform. They've got the cash to scale it up, to invest very heavily, and they now have a wide pipeline. I've mentioned some of them there before, but HIV, Zika, a flu vaccine that could be combined with a COVID vaccine and others, so you get it all in a single shot and with higher efficacy possibly than traditional flu vaccines have had, where the efficacies tended to be 20-50%, which is good, but not excellent. So that becomes a really huge opportunity set. And I think in some ways, COVID has been such an important thing for them, for us as a society, is that I think it's sometimes hard to see past and go, actually the value over the next 5 to 10 years could be a lot broader than that.
Okay, well, it's very exciting stuff. Now let's move on now to that huge energy transition, which is one of the three kind of legs here. I mean, we have to undergo a massive transition to stave off some really dire-looking consequences when it comes to climate change. So what opportunities do you see here? Obviously, Tesla, you've spoken about that. That's a big one. It's widely reported, though, that you've sold approximately 80% of the trust Tesla's holdings. So were there opportunities to invest those proceeds in other ideas around the post-carbon economy?
Yeah, and that's both what we have been doing and I think continue to do. I should say Tesla's still a large holding. I think their opportunity set is still fantastic from here as well. But on the energy transition, I mean, as you said, there's a huge environmental imperative for it. We need to do it to address climate change. But the other side of that is that renewable energy is in many cases a lot cheaper now than fossil fuels and continuing to get so. So it's not just an environmental imperative, but there's also a huge economic incentive to make the transition. And that economic incentive grows year by year. Energy use is central to sort of our society. And so that transition to a decarbonisation and new forms of energy is hugely material, hugely impactful. In terms of the different opportunities we're seeing, they're large and varied. So electric vehicles is one where we've mentioned with Tesla, still a large holding. We also invest in NIO in China. In addition to that, we've invested in Northvolt, which is starting to manufacture batteries for EVs. And that's an incredibly important part of it. As we hit the inflection point and need to decarbonize transport, the number of batteries we need goes up exponentially. They're based in what is increasingly a sort of a green hub in northern Sweden, where they're using hydroelectric power to both, again, keep the cost of that battery production low, but also to keep it green. We've also invested in Redwood Materials, which is founded by a former Tesla founder, J.B. Straubel, where they hope to sort of build out the recycling infrastructure for batteries. We've invested in ChargePoint, that's providing the charging infrastructure that we're all going to need. Tomorrow I'm heading down to London to spend 5 hours with the management team of another sort of business that's at the heart of the energy transition as well. So we're continuing to see a sort of range of opportunities here that again is quite exciting.
Okay, and then to move into the final area, which is of transformative change, which is really is the backbone, and it's doing a lot of the heavy lifting for the digital transformation, is kind of the microchips and the semiconductors. And you're a big supporter of ASML. Do you want to tell me a little bit more about kind of what the appeal is here and how the stock has progressed recently?
Yeah. I think ASML is wonderful because it's not a company that looms large in public consciousness, but it is incredibly important. ASML basically built the world's most complex machines, and these machines are designed to use light to etch in patterns onto chips, which is a vital part of producing chips in the semiconductor industry. They do this by harnessing a wavelength that only naturally occurs in space, but doing it inside a machine. They basically get a carbon dioxide laser, amplify it 10,000 times, and have to hit individual droplets of molten tin as they fall. It's really complex stuff. The machines cost $150 million, 100,000 moving parts, 2 kilometers of cabling. And they're really at the heart of the progression of Moore's law, of our continuing technological development. And so I think the first thing that's really interesting is, the digital opportunity is still huge. Every time there's an adoption of a new digital model or greater digitization, it effectively means more business for ASML as being that crucial component in the semiconductor industry. So that's a huge and I think very long-term structural market for them. The second thing that's quite anomalous around them is they are a monopoly. No one else in the world can do with EUV what ASML can. It's got to that level of complexity that the competitors have not been able to keep up with the advances, and they're now out there on their own as this integral part of our industry. And so that sort of leaves ASML as being, it's based in Holland, but it's probably the most important tech company people have never heard of. It's hugely important technologically, it's hugely important economically, it's even very important geopolitically. And I think for us, it's just a very long-term opportunity with that unique competitive position.
Well, let's delve into that long. I mean, we started with the long-term opportunity. Let's continue down that path, because in order to reach the potential that these companies have, you really do have to kind of stick with them. So how do you maintain that exposure over what can be decades? Do you want to talk to me a little bit about the relationships that you build there?
Yeah. So being long-term is behaviorally challenging. However, if you are able to be long-term because of a structure, a culture that exists in the case of Scottish Mortgage, I do think it actually makes investing a lot easier. So if we go back to sort of investing in electric vehicles, I think that was easier because we knew the battery technology would keep improving. We could see the trend lines. We knew the environmental imperative would sadly continue to increase. What we couldn't say was what point do you hit inflection in terms of EV adoption. That I think it becomes more difficult. And I think not having to make those calls around timing makes things a lot easier. Having to take a view of, if you have a 1 to 2 year time horizon of when something's going to happen, is a lot more difficult. The same is true of ASML. When you look, a lot of the research that was done around ASML, a lot of it was linked to the semiconductor cycle, because the semiconductor industry does go in cycles. And if you can time those cycles, it's great. But it's much easier if you just go, well, look, there's a huge structural demand for more chips. We know there's going to be a lot more chips in 10 years. We know it's going to be, again, a bit bumpy with those cyclical changes from time to time. But we know that the destination is going to be a lot better than it is today. And if we can just avoid the cycle and own it through there, we'll do very well. And so being long-term is incredibly helpful for those reasons, for allowing almost simplification. And I think you mentioned the point about relationships in terms of how you build these. It's having that attitude when you're talking with companies. Companies are run by human beings. Markets can bash them around a bit as well. It's being supportive to them in these difficult times, knowing that you're not going to immediately dump the shares because they've had a difficult 4-month period, but you're going to continue to believe in that long-term destination, that long-term mission. And it's also about encouraging and empowering them. I think one of the problems with financial markets is they encourage founders and companies that are public to be short-term. They encourage them to continually hit earnings targets every single quarter. And that in turn encourages them, whatever you do, don't take your earnings and reinvest them back in the business for that long-term opportunity, because that will reduce earnings and could lead to a share price decline. And so that is, being able to give them the confidence of, look, if you think the right thing to do is invest heavily and the share price declines, we're perfectly happy with that because we think it takes us to a better 5-10 year place. And if we can offer that support to companies and to founders, I think that helps solidify relationships, and I think they find that in turn helpful.
I imagine it's a huge risk, isn't it, as well, if you give up on these companies during difficult periods. I mean, that is, as an investor, that is a big risk, really.
Yeah, and I've sort of talked about in the past as being whole discipline, because we're looking for companies that can go up 5, 10, 15, 20-fold. And two things are therefore true. One, if you're going to do that properly, the company's going to sometimes go up a lot in share price, but the logical thing to do is not going to be to sell. It's not, if it goes up 10 times, the answer isn't to sort of sell after it's doubled, because actually you'll be missing out on a lot of growth and opportunity. Equally, the reverse is true. As we said, Tesla isn't anomalous in this. Most of our companies have 30-40% drawdowns. And I think the biggest difference is almost sometimes not the identifying, but the willingness to support and own them through difficult periods. Because I think for most fund managers and most individuals, when you see a company is down 30-40%, it creates a lot of behavioral and emotional burden on you. It's not a nice place to be psychologically. We always want to be permanently up. And so it's a challenge in those situations to not get caught up in the daily sort of market news and narrative, which is just a reaction of trying to explain what's happened in the last couple of days, but to focus on, again, where that company might be in the next 5 to 10 years. Because the worst thing we could do for shareholders is when these companies hit these bumpy periods, sell, because you're probably selling at one of the worst possible times, and you're also cutting yourself off from that extreme return potential. And there's, again, dozens of times of our companies where they go through these periods that if we had sold, we would have done a huge disservice to Scottish Mortgage shareholders. And I think you just deal with that by accepting that these periods happen, that they're normal, they're not abnormal, they don't always mean something is terribly wrong. Accepting that they happen and trying as much as you can to focus on what does this mean for the company in terms of where it's going to be in 5 to 10 years? Has it really changed massively the value of this company's potential?
Okay. Now I'm going to home in on that hold discipline once again, and how it actually applies to China, which we haven't touched upon really yet. So, I mean, with China's set to become the world's largest economy. Businesses there are sure to play an outsized role in the future. So, how do you approach investing there? Are there examples you can share of the exceptional growth that SMT looks for?
Yes, so I think you're right. China is a large and soon to be on many metrics, the world's eventual largest market. And that provides a huge opportunity set for that ability to scale and deliver outlier-like returns, which we've been referring to. So try and give a practical example. I think Deliveroo is great as a consumer. Across their markets, they do, I think, about 800,000 or so orders a day. Meituan, which does food deliveries in China, which we own, is delivering 30 to 40 million meals every day. The scale of the Chinese market is on a different magnitude. And I think scale does matter for those outlier returns. And it's also not just the scale, it's also the appetite of the Chinese consumer, and the mindset, I think, is even more willing to adopt new ways of doing things because of the process of change and rapid change China has been through, than we are or we see in many other markets. So that's one element of the scale that the market offers. The other is that what we've seen over the last 5, probably even 10 years is that we're finding that some of the most innovative business models in the world are actually emerging from China. We are very, very far away from this idea of China being a copycat. Increasingly, we find Silicon Valley and European entrepreneurs looking to China for inspiration. And when we ask them where their inspiration comes from, time and time again, it comes from companies like Meituan. Take, for example, ByteDance, the owner and creator of TikTok. That is not a copycat of a Silicon Valley model. If anything, it's in the reverse, and it's now globally popular. It's the world's most downloaded app. I suspect a number of our current listeners will no doubt be avid users. So the innovation there is really, really impressive. And also linked to that is just the ambition of management, the willingness to invest heavily and to shoot for those right tail outcomes. I think that's something that we see a bit in Silicon Valley, we very much see in China. We don't see quite as much as probably would be ideal in other parts of the world. Now, at the same time, I think the other thing we look to for, and this comes to your question as well, is this is true for all companies, but I think it's particularly true in China, and particularly even more true now. We're looking for companies that are clearly benefiting society in some way, so that the more they benefit society, the less likely they are to be regulated against or given a tough time because they're giving something back to society. William Li, who's the founder of NIO, we saw him many years ago, I think in Shanghai, he was quite clear that his vision for NIO as electric vehicles, the skies of Beijing and Shanghai are too smoggy, and that's not good for my children. We need to decarbonize electric vehicles as a way to do that. And he was quite clear that for him, going with the grain of society rather than going against is much easier. And I think that's something that we're looking for within our companies globally, but I think it's taken on a particular element within China that we need to find companies that are able to offer these sort of material societal benefits. Meituan and Pinduoduo, for example, building out a new consumption infrastructure for China, but particularly for rural areas and less wealthy consumers, I think are really material. And I think that's something that we need to keep focusing on, thinking of more as we go through these periods of questioning ourselves and going, is the social benefit that these companies are giving good enough to effectively allow them to scale and be profitable at levels we need them to be for them to be outliers?
Excellent. Okay, well, look, we are bang on 1:30, so that is our 25 minutes and our intro complete. So we're now on to the questions. and they have been coming in thick and fast. This computer has been bing, bing, bing. The first one, though, I'm going to pick up on, which relates to, it segues nicely into what we've just been talking about. And it relates to China. And it says, here it is. Scottish Mortgage Investment Trust has more than 10% of its portfolio invested in China. In view of China's human rights record, is Baillie Gifford prepared to review its willingness to invest in China? So you just spoke there about the social benefit. So let's see the flip side of that and how you're handling the negative press, I suppose, around social concerns.
Yeah. So I think the first thing to say is that, and this again applies generally when we go to China specifically, when you have a 10-year time horizon, investing in companies in general that are having material negative externalities is not, to me, a comfortable place to be, because they'll either be innovated away, regulated away, or a consumer backlash. So, one of the questions we ask ourselves is, does this company make society better? And that's true across all companies. But as it pertains to China, again, we're looking for companies that in some way are helping society. So whether it's Pinduoduo getting cheaper food and everyday necessities to people, whether it's the building out of the cloud infrastructure. Now, how you deal around human rights, China has a very different perspective on the world. It also has a different value system. And I think the way I've tended to think about this has really been, what is likely to give, even from our value perspective, the best outcome? If you withdraw all foreign and international capital from some of these Chinese businesses that we have those relationships that we're able to talk to and to express certain things to, is that likely to make China more like the China that some people want, or less like the China that people want? So I think it's the ability to continue to invest means that you continue to have a little bit of influence, but more than that, I think it continues to have a dialogue on these issues. So I think having that influence of an international shareholder base is helpful. I think if it was withdrawn completely, I don't think that would make China necessarily a better place to be. Now, obviously, within that, there's lots of different companies within China. We're not trying to own the China market as a whole. We're trying to own a select number of companies that we think are driving technological progress and that are sort of relatively far away from some of the issues that you were alluding to there as well.
Okay. So China is very much going, it wants to court international investors. So it's appealing to interests here, and you are seeing kind of open dialogue to address some of these.
Yeah. So we've had calls on these issues. We've had a call recently with Alibaba about ESG, where they've asked us, what is important to you in terms of ESG? I don't think ESG is the greatest of terms. I tend to think more of a societal impact, and we've had those conversations. And I think because they have international shareholders with different perspectives, that does change the nature of the conversation. I know that's not a perfect answer to some of the fears that are being raised here, but I do think it's just being involved in that conversation, I think, is helpful.
Okay, right. Another question here. Could you talk about the current geographical distribution of investments in SMT? It seems to have shifted somewhat. Is this only because of relative changes in the price of certain holdings, or are you actively shifting the regional balance of investments in the trust?
I wouldn't say that we're materially actively shifting the regional balance, but what I would say is, I think over time, I wouldn't be surprised if, we've seen a lot of our opportunity sets come from, in terms of outlier companies, from sort of Silicon Valley, West Coast of America, East Coast of China. I'm hopeful that we're now seeing a few more disruptive growth companies in Europe emerging, and that in turn makes it easier for the creation of future European companies, because they have inspiration, they have the talent pools, they have the VC ecosystems. And we're also seeing other regions of the world that are now starting to digitize and build a lot of their own companies, and are getting that virtuous circle going. So, I first invested myself, about a decade ago in Mercado Libre, and at that point they were basically the only real sort of technological digital disruptor in the region. But today they're an inspiration to other founders that are coming through, and you see a much more diverse opportunity set there as those companies have been built up. So it wouldn't surprise me if over time we find more regions of the world where we're seeing the sorts of companies that have our growth profiles. I suspect West Coast of America, East Coast of China will still remain key, but I think you probably end up seeing a little bit more sort of spread of where some of those companies are coming from. And one of the things I think we need to do as Scottish mortgage managers is we need to make sure that we're plugged into all those different ecosystems, that we have those relationships, that we can build up that domain knowledge over time. We're doing that in regions of the world like sub-Saharan Africa. It might be some time before we see sort of companies at that scale come through, but you need to, it's helpful to go to these regions early and build those relationships so that you can be early partners when they do emerge. And also being plugged into different regions of the world, I think helps sharpen your perspective of what you're seeing elsewhere. And that goes back to the China one, that seeing that business model innovation in Meituan is helpful for us to understand what Delivery Hero might be able to do, what DoorDash are being able to do. You want to be approaching the world not just from an American perspective, not just from a UK perspective or a China perspective, but as much as possible from having a genuinely global perspective.
Okay. Moving now on to a question which is a bit more structural in nature. How many are in your team? And do you feel you've lost some creativity and in some of the informal meetings which has been brought about by the pandemic? So how's your day-to-day changed during the pandemic?
Well, I think it's important to be honest here, and the honest answer is it's got a lot more boring. In terms of, a Zoom call is not the same as meeting people face to face. And I think many people will sort of feel that way. I think for us, we've been able to very much maintain the relationships that we've had and also build some new ones within the Zoom and the pandemic environment. But and we've, as I said, we've done some overseas investment trips, and I've met a company in person just this morning. So we are doing more of that. But I think as we go forward, it is very important for our insight to be able to go and meet people face to face. It is very important for us to travel, to go and spend a month in China, a month in Berlin, a month in Buenos Aires. The types of connections and the serendipitous meetings that you end up having are much more valuable. I think that is an important part of what we do. I think we've been able to do it okay over Zoom, but I don't think that's as good as the real thing. And I think as we start to ramp up, that will be a good thing for us to do. The second part of the question was about team. There are over 100 investors in Baillie Gifford, all with a sort of long-term focus that I've been talking about, and that gives us a lot of people meeting companies, individuals, academics. It gives us insight. In particular, in addition to myself, Tom and James, we've got a number of high-growth equity investment teams in Baillie Gifford that we work with and are involved with and work very closely with. We've got our long-term global growth team. And these teams will be sort of 6 to 8 people. We've got our North American equities team that Tom Slater heads up. We've got our international growth team that I'm involved with. We've got our healthcare innovation team, which is led by a close colleague of mine, Julia Angelis. And so there's a lot of support there that we're also getting in terms of ideas and also building some of these relationships that are helpful. But yeah, I think the sooner that we're able to sort of more regularly get back to doing investment trips and meeting face to face, I think the better. Really.
Yeah, 2 years on, we're all feeling the same, I think. Okay, another question which is a bit more structural in nature. The session is titled "Why Access to Entrepreneurs and Visionary Founders and Academics Matters." One viewer here would like to learn a little bit more about some of those academic relationships that you have. Could you, Brooke, talk us through those?
Yeah. So I think we've found the academic relationships really, really important to us. They're helpful because what we're really doing is saying, if we want to do the best possible job for Scottish mortgage shareholders, only a fraction of the insight is naturally going to be embedded within the three of us or within Baillie Gifford. We need to make sure we're getting genuine insight, broad insight from the very best minds that we can globally. And so being able to get that insight, whether it's company visionaries or whether it's academics, to us is absolutely key. Building those networks that will help shape our ideas and shape where we spend time doing research. Academia is particularly fruitful because academics don't think on a 1 to 2 year horizon. They think on a 10-year horizon. They think on a multi-decade horizon. And that really aligns very well for us. What also aligns well is that we're patient. So we talk regularly, for example, to Brian Arthur, who's a leading complexity economist, leading in complexity science. And he's been very helpful in shaping how we think about AI and how we think about technology. He was, he's one of the world's, in my view, sort of leading academics. He was one of the first people that sort of spotted the nature of the digital economy, and having those conversations really helps us. And what also helps us is we're not going in and saying, "What do you think of company X? What do you think of company Y?" These conversations tend to be more about what is interesting to you in the world. What are you thinking about, and where do you see change? And we can do that because we're not looking for immediate answers. We're looking for things that might input today, they might input in 5, they might input in 10 years. And they've been really helpful in shaping how we think about things. And all of these are information networks, and they're never entirely contained answers. They're individual dots in a puzzle. So Brian Arthur is telling us, as he has told me when I visited him in Palo Alto, and we have talked to him over Zoom as well, these relationships haven't gone away in the pandemic, but that AI is the most important technological development since Gutenberg's printing press, where Gutenberg's printing press made information more widely available. AI is making intelligence more widely available on tap. And then we were meeting, Robin Lee, who was talking about the importance of AI at Baidu many years ago. That sort of helps focus us of where we want to spend our time, what do we think is interesting, what do we think are the areas where outliers are likely to emerge. And it's also been very helpful in building out those 3 growth areas we alluded to earlier. And so that those academic networks combined with the company networks are really where we get a lot of our insights and that drive a lot of our thinking.
Okay. Right, we have a lot of, we've got nearly 100 questions here that have come through, which there's so much to get through. But I mean, looking through the list of questions, I mean, there are some obvious trends in them. So one of them really that I think we should address head on is lots of people still asking about the recent dip, and could you put some kind of reasons behind it? So could we talk about the recent volatility of the fund and give our viewers some explanations there?
Yeah, sure. So I completely get that any amount of volatility in times like this, it's difficult to stomach. Nobody wants to see it. It's not unusual. About a year ago, we were sort of experiencing a similar sort of situation as well. In terms of what's driving it, I think what I can say, I mean, there's obviously the interest rate inflation narrative of what that does to earnings that are far out in the future, making them less valuable, and that disproportionately sort of impacts growth companies. And that's become a narrative that's become quite important in driving some of the buying and selling within markets. The other element of the narrative has been people sort of trying to time a reopening and various things like that. But I think from where we sit, when we're looking at most of our companies, do we see a massive fundamental shift in the progress that they're making or their operations? Frankly, we don't, not at this point. And a lot of the trends we're in, we don't think that they've been helped by the pandemic, but they're not because of the pandemic. They're structural ones where that digitization has been brought forward, that demand has been brought forward and accelerated the opportunity. And so from our perspective, it really just comes back to where do we think these companies are going to be in 5 to 10 years' time? And I don't think our views have radically changed on any of them, particularly between now and say November, before we've hit this recent bit of volatility. I think what needs to be quite clear is that what we are not good at, and what we should never claim we're good at, is in any way predicting those market gyrations. So any views that we have on the next 6 to 18 months of markets, I think should be rightly discounted. What we're trying to maximize for Scottish Mortgage shareholders is, how do we get the maximum returns on a 5 to 10 year basis, not how do we sort of smooth out the 6 to 12 months. And I think we just need to be clear and open in terms of what we're trying to prioritize, because I don't think you can get those big long-term winners and have smooth short-term performance to the extent that that's even possible anyway at the same time. I think they're somewhat exclusive.
Okay, thank you. Another common question here is James Anderson is obviously leaving in April. Can you tell us more about the transition?
Yeah, so I've worked with James closely in other strategies that we work on together for over a decade. I think he's been, needless to say, incredibly important to Scottish Mortgage, but also very important to me as an investor, working closely and learning from him. So what I would say about that transition is that, firstly, there's that sort of decade-plus relationship of working and investing alongside him, including in a number of the companies that are in Scottish Mortgage today. I think the other elements of the transition have been, passing on some of those relationships that we've been talking about with companies that might have been more in James's court than mine or Tom's. Some of those academic relationships as well, which he's been very generous of introducing us and building us up to. And that's been quite a helpful part of the transition. I think the other part of the transition, and we've done this really over the last 10 years of learning from James in the different areas, but also trying to understand, the evolution of Scottish Mortgage and the leaps in methodology, where they've come from and what's generated it. And what's come back time and time again, I think, from James has been how important those external relationships, academic and company, have been to developing his thinking over time. They've really inputted and shaped a lot of his creative thinking. And so I think where we're in quite a good position is we still have a huge task in front of us. But, 10, 15 years ago, those networks of relationships didn't exist. Today they do. And that knowledge, therefore, is still something we can draw on, and we have to keep, what we need to make sure we need to keep doing is not just leverage and utilize those networks as they exist today, but also to make sure we expand them and improve them in the future. And so that, we're not looking to plateau. We have to be constantly looking to get better. And I think that really is a mindset that James has been central in imparting on me and Tom, and it's one that I think we take very much to heart as being our challenge going forward, that Scottish Mortgage needs to continue to evolve. It needs to get better. We will never reach a point where we've solved investing. We must keep getting better.
Okay. We've heard now about your whole discipline, especially when it comes to China. Could you tell us more about your sell discipline?
Yeah. So again, I'd probably start with the caveat that I think the whole discipline is both more important and harder. A whole discipline avoids not doing something every day, which is selling. Selling, by comparison, is quite easy. It takes a few minutes to do it. A whole discipline is something that comes across over a decade or more. In terms of sell discipline, it really comes back a lot of the time to our philosophy. What we're looking to do for shareholders is own companies that have the ability to go up 5, 10, 15, 20-fold. Now, eventually, at some point in the company's life cycle, it reaches the point where that ability is, or the ability to do that is more difficult. And we have had examples of that. We've been reducing, for example, our holding in Amazon. We think Amazon is a great company, but at $1.8 trillion, the ability to see a 10 times return is naturally a lot more difficult. A, and B, I think we take very seriously the stepping back of Jeff Bezos, who's been so instrumental to Amazon's progress, but also Jeff Wilkie, who's also been very instrumental to their progress, and that Amazon is perhaps far less of a day one company than it is today. And so, that ability, and it's similar with Tesla, that as we reach points where $1 trillion market caps, and we go, well, as we go through our scenario analysis of can a company go up many multiples from here, and we start to struggle. Then we do start to make portfolio changes based on that, because that's being true to our philosophy of looking for those big winners that are capable of delivering those returns. And I think what I would say, though, as well, is that when we are selling, it's not selling because we're selling through sort of fear quite often. The competition for capital has been, I think, the most marked thing of the last 18 months of Scottish Mortgage, that we're seeing lots of opportunities in those three big areas we talked about. We talked about the different energy opportunities. And so quite often where the challenge is coming from is there are exciting new companies that we think have huge potential, and we want to make sure that we free up capital to be able to invest in them. And it becomes a trade-off, therefore, of those two things. How much upside do some of these companies have from here compared to some of the newer companies where the outcomes might be less uncertain, but the upside potential is potentially far greater. And that's a lot of the time in our conversations how it tends to come from. And I think it's really being in that position of being quite spoiled in terms of the growth opportunities over the next 5 to 10 years that we're seeing, and needing to free up capital for those opportunities.
Okay, and in the closing minute, one of these opportunities, we've got a question here. Predictions for SpaceX, please. Is there going to be a manned trip to space by the end of the decade?
I don't think I'm the best person to sort of do the predictions of what governments or private companies will do around space, but I think what I will say is, I think the opportunity that SpaceX faces is absolutely huge. The ability to massively take down the cost of getting into orbit has all number of benefits. A lot of the time what we see from Blue Origin and SpaceX is the ability to, sending William Shatner into space is great. I love to see Captain Kirk go into space, but a lot of the opportunity set that they have here is really about how do we put satellites into orbit cheaper? And that means you can start having more satellites that are able to measure climate change, that are able to measure agricultural efficiency, that are able to put, as Starlink is doing, a constellation of low-cost satellites into orbit to provide broadband to, if it's rural areas, to Scotland or sub-Saharan Africa, where building out fixed-line infrastructure was never going to be possible. And so space, I think, is an increasingly important domain, and the ability to offer cheap access there, just for orbital space before we get onto the moon or Mars, is very important. And then, I very much believe in Elon Musk's long-term vision that for us to be an interplanetary species, something will go wrong on Earth. The magnetic field will reverse, the sun, something will happen. The ability for us to go off and to colonize elsewhere, I think, is very, very important. But there are also some very important commercial steps that I think offer shareholders great returns before we get there, that are part of the stepping stones of building that capability.
So, I mean, the second order impact then of space exploration seems like a huge opportunity, and one which is actually quite grounded in real life issues.
Yeah. I mean, that's the thing. Sometimes you get the, wouldn't it be better if they solved problems on Earth? And there are problems on Earth, and we should look to solve them. And we've been talking a lot of them about the energy transition. But some of the things that we can do in space, as you're rightly pointing out, also provide a solution there as well, that's helpful. And again, I really wouldn't discount that in the very long term, for us to develop as a species, going into space will be necessary. And I think having the private entrepreneurship that we've seen go into this industry has really accelerated what's possible. And that's a good thing. And I think the benefits are broader of that than is perhaps sort of commonly assumed.
Okay, Lawrence, now that's all we've got time for today. A truly fascinating and wide-ranging discussion today. So thank you very much for your time.
Great.
And thank you all, viewers, for joining us and for your time today. And for your questions, for which there were hundreds. We have more sessions like this coming up, so do keep an eye out for those if you found today useful. That's all from me. Thank you.